There is blind justice, and then there is trading justice, so that you can finally afford to get that laser eye surgery. Not only will people find you more attractive once you ditch those old glasses, you'll be able to see your charts better. That's what we call win-win. Speaking of winning, it's time for a little trading justice. Brought to you by TackleTrading.com.
Welcome out to the Trading Justice Podcast presented by Tackle Trading. My name is Matt Justice. I am your host along with my co-host Tim Justice. If you've not yet been over to Tackle Trading but you enjoy the Trading Justice Podcast, we are just changing lives one trade at a time over there. Get over there at www.tackletrading.com. Sign up for the pro version. Get my Forex report, which is an absolutely killing it for about 5 straight months. You can get Tim's upcoming commodities report, Noah Davidson's equities report, and Gino Poor's options report. We're doing it for you so that you don't have to do it by yourself. One trusted source over there, changing lives one game at a time, one trade at a time. Tim, how are you today?
You know, I'm doing amazing. I'm excited to be back, and I'm excited to talk about what we have on the docket today. I think there's a lot of really interesting things going on out there in this world, including Greece and Europe with the ECB and these central bank decision-making policy statements that we've been seeing. So I'm stoked, man. I'm happy to be here.
You know, it's a very fluid situation over there in Greece, in Europe, and honestly, in the marketplace as a whole right now, things are changing seemingly daily. I did my Forex report yesterday, Tim, and honestly, it was tough to make some defined calls this week in the market, just given kind of coming up with the Fed, and we'll certainly talk about the FOMC coming out tomorrow and whatnot. But it's a very fluid situation that is ever changing. So we want to bring on our Greek expert, Solon. Solon, how are you today?
I'm doing great, guys. Glad to be here.
Awesome. We had Solon on the podcast about 3-4 weeks ago now, and we were talking about austerity and the Greek situation, the Greek problem. So we want to bring Solon on again just to kind of give us an update on what is going on with the Greece situation, and we'll get into that in just one second. But before we get into that, Tim, I wanted to get your take on the marketplace right now. The market's been coming down just a little bit the last couple weeks off the highs of 21 and whatnot, and it's right now down. I believe the last traded price on the ES contract was at 2066, so it came down off the highs of 2100, 2110, about 50 point downward movement. Just a retracement. Tim, are you concerned? Is your let's put it in your risk scale, 0 to 10. 0 is the most complacent market ever. 2013, we're doing quantitative easing infinity, and you're the 10. So that's the 0 scale. The 10 part of that is the subprime market crash, the .com market crash. On that risk scale, what is your risk in the market right now?
Well, if you define it by the market at whole, I would say it's probably a 6 or a 7. If you're just looking at equity prices, which a lot of our listeners probably have a 401k or an IRA, or they've got mutual funds or something like that, hopefully they're starting to move to the point where they can take action and take control themselves. That should be a very big goal for everybody out there. But if you're looking at equities, I don't think it's as high in the short term. And we've looked at and we've seen Federal Reserve policy decisions lately, probably the last few years, Matt. If you go back and run the numbers, and I've done some back testing on this, the actual response in the equity market is not always that big. But there are some differences right now that have not been there before. The upcoming interest rate policy changes, we think they're going to raise rates. You're probably going to talk about that in just a minute. So I'd say it's pretty high when you factor in commodities, when you factor in the bond market, and when you factor in the currency market. I don't know if it's as high for equities, though.
Mm-hmm. If I had to say, I'd probably say we've been at an 8 or a 9 for the better part of the last 6 months in oil, and probably a 7 or 8 in the other commodities such as gold and silver for the better part of the last few years, actually dating back till 2000 and late part of 2011, early 2012, and so that's nothing new for the commodities out there. They've been hit pretty hard over the course of the last little bit. In the currency market, it's an amazing market because in the currency market, you really don't have, I mean, when there's risk to one currency, that's a good thing for another currency, right? And so when you're looking at that marketplace, if you're looking at the Eurozone, if you're looking at the yen, if you're looking at some of the emerging market currencies such as Brazil and Russia, although Russia's kind of stabilizing, the Indian rupee and some of those other emerging market currencies, it becomes a little bit more concerning out there. But when you're looking at the U.S. dollar, I mean, who's concerned about the U.S. dollar right now? It's at a multi-year, if not a decade high. It's about 106, hovering around 106 on the euro dollar pair for the better part of the last few days. Most likely that's going to pair eventually. The U.S. dollar on the DX contract went to 100. So I'd say that the dollar out of everything is probably the most stable of all of the markets right now. And in the equities market, I'm not too concerned right now. Not yet. We'll talk about the Fed and future projections and whatnot, but I'm not too concerned yet. And I was given a presentation this past week, Tim, out of Burbank, California. I was down there presenting for Rich Dad Education and had a great group of students down there, and it was a lot of fun. And, I do this piece called the market cycle. And in the market cycle, I talk about what creates cycles, what creates bubbles. I talk about protection in those, such as, buying a protected put option. And I go over the GDP cycle versus the technical cycle. I compare this marketplace against other marketplaces. And honestly, when I do that market cycle piece, and you've seen me do that market cycle piece many times, Tim, but when I do that market cycle piece, people get a little scared. And they always come in, should I go cash? Should I go cash? Should I get out of the market? I'm like, no, we don't take radical action in any one thing. We are proactive, and we basically take a very, we want to be moderate in our approach. We want to be conservative in our approach. But when I look at the marketplace, I really don't see any macro risk to the equities market, at least for a few months from now.
Well, I think that's true, and I want to take this one step further. See, take the U.S. dollar. I don't have very much faith in the long-term value of the U.S. dollar. Okay, changing economic conditions, changing role as the reserve status around the world, other economies popping up and bringing their currency to the table, different consuming habits using digital currency, and all over the world, really, including Bitcoin, but not limited to Bitcoin. There's a lot going on out there. I'm not real bullish on the dollar, but I've been extremely bullish on the dollar short term because there's a phrase in trading, Matt. You have to trade what you see. Yep. You don't trade your politics. You don't trade what you think. You don't trade what you want. You don't trade what you hope. You watch for the charts, and while the charts are strong, you have to play that. You said something last week on the coaches show I thought was really interesting, or maybe a couple weeks ago. Don't fight the dollar. Don't fight the dollar. It's been so strong right now. Now, eventually, that's going to change. Things change. It will. But you trade what you see.
First of all, you don't fight the Fed and you don't fight the dollar. Those are the two things you don't fight right now. And when you look at the dollar, it's been extremely bullish for the better part of the last year. It's been one of the easier tradable instruments, although there are times where it becomes a little bit more difficult. We are going through one of those times right now. But you don't fight the dollar. But at the same time, there is a massive difference between short-term analysis and long-term analysis. Long-term analysis, I could not be more bearish on the dollar. I'm probably one of the most biggest bears on the dollar if you look 10, 15 years from now. But in 10, 15 years, we're only going to have about 100 different trends. Mm-hmm. We got not step A to B to C. We got to go around the world 15 times before we get to that ultimate bearish stage of the dollar losing reserve status, which, by the way, there is absolutely nothing that I have seen in the last year that leads me to a conclusion that is different than my overall conclusion that the dollar will lose reserve status. What's going on in the dollar has nothing to do with reserve status. Nothing. It has everything to do with what is happening right now in the emerging markets, what's happening in the Eurozone, what's happening with that Greek situation, what's happening in Japan, what's happening with the worldwide marketplace. I mean, Tim, since Lehman Brothers went kaput and bankrupt in 2008, September of 2008, the U.S. Central Bank has only lowered interest rates one time, Tim. One time. Just once. Okay? Guess how many times the world market when you look at every currency out there? Just take a guess, random guess. How many times do you think the world market has lowered interest rates?
How many central banks are we counting this on?
There's only 8, but there's not only 8 interest rates. You have all the emerging markets. You have lots.
Hundreds, then probably
522.
Yeah.
522 times there has been a currency in the world that has lowered interest rates since the U.S. went to the ultimate low of 0 to 2.5 in 2008, 2009. And so when you look at that and you're saying, okay, the U.S. has had this interest rate, and yes, they've been doing quantitative easing, which has lowered their bond market. But at the same time, the U.S., they haven't lowered interest rates in a very long time because they can't, right? Mm-hmm. But in terms of the rest of the world is really starting to catch up. You've had 25 decreases in interest rates already this year, and you look at this, the underlying fundamentals of the dollar is going to remain. Okay.
Let me ask you a question, though, Matt. I find this one interesting because people will say when institutions are nervous, they move to cash. That was traditionally, historically, something that you would see happen. Where can they move in an environment where currency is no longer a safe haven or stable place?
Well, that's a great question. So they go to cash. Most institutions do not go to cash. They go to some form of investment, right? And there's so much money. I mean, when you look at the marketplaces, let's identify this. You have the equities market, which is a $100 billion, $200 billion daily industry. On the New York Stock Exchange, only about $30 billion. I say only, but we are talking the world market here. $30 billion is basically exchanged every day. The bond market's about a $400 to $600 billion daily industry. The commodities market, a $400 billion daily industry, and that's crude and gold and silver and whatnot. And then you have the currency market, which is a $5.3 trillion daily industry. What institutions are doing right now is, and this has been going on for about 8 months now, what they're doing right now is they're getting into the dollar. So when they say go cash, they're actually getting into the dollar. They're buying more U.S. dollars. And they're doing this through a couple different ways. Either one, they're doing it through the bond market, or number two, they're doing it through the closing of the carry trade, because the carry trade is basically for 10, 15 years has been selling the dollar, buying other emerging market currencies. But because of what's happening in the global markets, that trade is becoming very, very, very risky. So they have to buy the dollar to get out of that trade, or that you might just have people just start buying U.S. dollars in terms of the currency market just as a safe haven investment. All of this leads to the dollar continuing to gain strength.
Mm-hmm. Yeah. Yeah. And here's the thing. If you're out there listening and you're trading, there's really a 2-step process to any kind of trends developing. First, protect yourself, and then learn to profit. Because when these things happen, there is an opportunity, but you got to make sure that whatever investments you have, whatever retirements you have, whatever businesses you have, they're first protected. You know, whether that's through protective puts or derivatives or just a stop loss or position sizing or whatever. You know, everybody's going to have to come up with a plan, and maybe you need to sit with a mentor to do that. But then there's a way to profit. You know, Matt, I ask this question in my class all the time. You know, crude oil's been in the news for the last year, really the last 10 years. It's a big mover. It's dropped from over $100 a barrel, I think 110 at one point last year, down to where it's at, the mid-40s right now? And all signs are continuing to point for pressure.
Yeah, you hit a midpoint of 42 yesterday. That was at the low here. I believe the current price on crude, let me get it for you, is 44.41. So it rebounded a little bit today, but at the same time, it's been getting beat up pretty good. That should continue as well. You know, I want to bring on our guest really quick, Tim, because it kind of leads into this discussion. Solon, how are you, buddy?
I'm doing great, guys.
Awesome. Hey, Solon, we're talking about the global marketplaces. We're talking about the dollar. We're talking about some of the reasons this continues to impact the price action and whatnot. I want to ask you a question. If, in your estimation, given what you've seen, do you believe that the Greece situation will be resolved with Greece leaving the European Union, or will they find some degree of measurement to stay in the EU?
Well, I see that as Greece is going to negotiate something with its creditors. I feel like measures were taken already, with the 1.1 trillion euro quantitative easing program that you guys talked about last week, to stay within the IMF, the European Central Bank, the European Commission. They all took measures to make sure that they have enough cash in hand, enough liquidity that if Greece does need another bailout, if Greek banks do need the ELA, the Emergency Liquidity Assistance, that they're going to do whatever it takes to keep the European Union whole. And stories have been coming out lately that, if Greece leaves the euro, the European Union is not going to be sustainable anymore. So I do feel like there is a lot of jockeying right now for terms. There's a lot of posturing by all parties involved just because they have to be held accountable by their constituencies. But in the end, a deal is going to get done, and it's going to probably be the best deal for all possible parties.
Mm-hmm. I want to get your take on this. I've just in the past couple of weeks, we've seen none other than Steve Forbes, and you've seen George Soros. You've seen finance ministers out of Great Britain all say that basically either one, there is no way possible for Greece to pay their debt. There's just the numbers aren't there. So there, and if Germany doesn't do some type of debt forgiveness program, it's just not going to work. You had, and then you had others come out like the EU president and Mario Draghi also came out and said basically Greece leaving the Eurozone would be disastrous for the European Union, the ECB, and it could be the beginning of the end of the EU and the ECB, and ultimately the euro as well. How do you suggest? Because you're Greek. How do you suggest in terms of just everything you're seeing out there? How do you suggest someone like all of us who didn't grow up kind of understanding the demographics and the situation over there and the differences over there and the political parties over there, how do we go about just understanding what we should be listening to? Because there's so much information coming not out of Greece, but everybody seems to have an opinion these days over what Greece should do, what they shouldn't do. If they do this, it's going to be disastrous. If they do that, it's going to be disastrous. It just seems like everything is such a negative right now.
Yeah, and to answer that, I feel like some of the hysteria that's out there is a little overhyped, overplayed by all parties, by the media. Also, Greece has something to gain from playing up the debt, that the debt is unsustainable, that there's a humanitarian crisis. They're going to play up that debt just for negotiation purposes, I feel. Because when you look at it, I don't believe that the debt is unpayable. It's a 300 billion euro debt, and 300 to 310 billion euro, and the Greek economy right now is at 220 to 230 billion euro. It's slightly fluctuating, and it's going to rebound. The main issue with the Greek debt crisis, and it's kind of the narrative that the finance minister, Yanis Varoufakis, who we spoke about a couple of weeks ago, and the main narrative that Alexis Tsipras, the prime minister of Greece, have brought to the forefront is, how does Greece get back to productivity? How do we grow the economy again? Because if you think about it, from a nominal debt to GDP ratio, if the GDP of Greece starts rising again, then the ratio will drop. The ratio of the debt to GDP is going to drop in comparison if they can get productivity back. Because one of the stats that I read a few weeks back was that Greece's debt per capita was about 24,000 euro, I want to say. And that's not too high compared to Italy and France have the highest per capita debt. So the main issue with Greece is that they have a 26% unemployment. They don't have the productivity in the economy right now, and you're seeing Greece suffer, and the debt is just swollen. So what they have to do is restructure and put in the reforms that has been talked about in the news for the past couple of weeks in order for the economy to grow again.
It's amazing you just said that. Now, let me make sure I got this accurate. What was the per capita debt burden in Greece?
Per capita debt burden is, I believe, 24,000. I'm going to try to look it up during the podcast, but I think it is around 24,000. France and Italy, I believe, are over 30K a piece.
That is amazing to me, because there's so much negativity about Greece's debt problems, and they are in debt, and they have a very difficult time, balancing their budget given some of the things that are happening. But Tim, when you hear that number, that 24,000 per basic debt, let me give you a number, Tim. Mm-hmm. U.S. total debt, if you add up every piece of our debt, right? The national debt, federal spending, consumer debt, mortgage debt, student loan debt, credit card debt. Let me give you some numbers for the U.S., okay? U.S. total debt is $61 trillion, $61.278 trillion. Total personal debt is $16.8 trillion. U.S. national debt is $18.155 trillion. Mortgage debt is $13.4 trillion. Student loan is $1.3 trillion. Credit card debt is $886 billion total in the U.S. Total debt per citizen in the U.S. Okay, now you heard Solon. What do you say? 24,000 per citizen? And Solon, if you could double check those numbers, that'd be great.
Yeah. It's 28,000 for Greece, 28,622, 32,323 for France, 38,491 for Italy, and the U.S. is at a whopping $65,902.
Okay, and that 61,000. Thank you so much for putting that out there, because that doesn't include all U.S. debt. That just includes a portion of U.S. debt. If you take into account every aspect of the U.S. debt, it's actually $191,285 of debt per U.S. citizen. So let's put this into perspective. Greece is in a debt problem, absolutely no doubt about it. They have some issues from a GDP perspective, no doubt. But Tim, what does that make you think when you hear those numbers in the Eurozone, 28,000, 29,000, 30,000, 31,000, compared to the U.S. consumer debt at 61,000 and U.S. total debt at 191,000 per citizen?
Well, it makes me think that for some reason, the international, economies and banking institutions, governments, they're much more willing to let the U.S. economy slide into this massive debt problem without calling them on it. And I think that there's a lot of reasons possibly for that. Some of the guarantees from the U.S. Treasury market that they always get paid, the strength of the U.S. dollar, the manipulation of keeping it where it is in the place of world reserve currency. But it's really a shocking number when you think about it, because this is after supposedly 7 or 8 years of economic strength. Or 7 years, I guess, if you think about the numbers. We bottomed in 2009. You said we haven't even raised interest rate in a long time, and yet here we are with all this money that we've created, this debt problem. It doesn't even seem fathomable that we can...
It's absolutely amazing. And I knew the numbers were as bad as what Solon suggested. But we also got to realize that this is one of the growing problems between the international markets and the U.S. market, between U.S. citizens and international citizens in foreign countries and whatnot. And one of the growing reasons that, outside of foreign policy, that the rest of the world looks at the U.S. and some type of envy / greed / I can't stand you type mentality. It's because we can go into debt as much as we want from an economic standpoint, because we do something that Greece can't do. Because if Greece did what we did, they would hyperinflate and kill their national economy. If Greece printed a singular currency to print against the debt burden, it would cause hyperinflation. Well, we print against debt all the time. which means we go into debt and more debt and more debt and more debt, and nobody cares about it because we just print more and more and more money to offset the debt burden. But there's going to be a time, and this is the one thing I want everybody to understand out there listening to the Trading Justice podcast. There's going to be a time where the U.S. will not be able to print against debt. Now, you think about that European debt problem right now. You have Greece at 28,000. You have France and Italy and Portugal, and every European Union has a debt problem. But it pales in comparison to the U.S. What happens to the U.S. economy? What happens to the U.S. engine? What happens to the U.S. citizens' money if we can no longer print against debt? What do you guys think?
Well, the currency, honestly, I'm trying to even wrap my head around it, because that's really the future we face, Matt, at some point.
Well, First of all, what is the one thing that is different about us that the rest of the world really can't do to the same extent that we can? We are the world reserve currency. We can print as much money as we want. Our money doesn't just stay home. It goes everywhere else as well. It goes over to the Eurozone, Great Britain, China, Russia, emerging markets, Australia, Japan. It goes everywhere. It's utilized everywhere as a global currency. And so because of that, you can print and print and print. The rest of the world has to use your currency in international trade. The question becomes, what happens when we can't print against debt? What happens when we are facing a very similar economic or monetary environment that the Eurozone is faced in right now with the Greek debt situation, or what Brazil is faced with right now, or so on and so forth. So when we're looking at this, let's keep this into perspective, because, we look at this from, we're surrounded by the Pacific Ocean, the Atlantic Ocean, and we're like, oh man, if those Greeks, wow. Solon, I cannot tell you how many times I've talked to economists or traders or even just new individuals getting into trading. They're like, well, if Greece didn't have 70% of their national debt in social service programs and government welfare, and if they didn't run some socialist state, they wouldn't have these problems. I want you to speak to that, because I hear that a lot. Now, I don't agree with everything like that. I do believe, Greece has to reduce some of their government spending on employment and whatnot, but at the same time, speak to the radical nature of the news information that we hear stateside in terms of the reality of what that's going on in Greece.
Yeah, it's a narrative that's out there that Greece is messed up to a certain extent. They need to make reforms. There's no doubt about it. One of the major reforms that they need to make are labor reforms. Collective bargaining in Greece and in Italy, the labor unions are just way too strong. It makes it very difficult to hire people. It makes it very difficult to let people go, and that's inhibiting businesses there. Now, I sent you, I know I emailed you an article a few days back, and the title of the article was From ZERP to NERP, ZERP being zero interest rate policy to negative interest rate policy, virtues of Germany versus the vices of Greece. What about Spain and Greece, and gold? And it's a great article. It's extremely deep, actually, and it discusses the structural reforms within Europe. How from the creation of the euro, you saw capital flight exiting from Germany and going into Southern Europe in the form of debt, and now we're starting to see capital actually leaving Southern Europe and going back to Germany. And some of the numbers, the capital that's leaving Spain and Greece and Italy right now and going into Germany is just ridiculous. And when you think about the liquidity crisis, because the main mass media kind of portrays the liquidity crisis in Greece as just Greek people are nervous and pulling their money out of banks. Well, they're also not taking into consideration that German banks are actually siphoning out money from Greece, Spain, Italy, France even, and Portugal and Ireland. So there's actually massive structural reform that needs to be done throughout Europe, because currently it's kind of like Germany and all the little dwarfs, if you want to think about it that way, because Germany's economy is the only one that's actually prospering in the European Union, just because of how well their country is set up, how deep their infrastructure goes, and the infrastructure of the other European nations, the banking system of the other European nations, aren't set up to be in an integrated EU. So there's massive problems in there. And yeah, Greece, Spain, Portugal, Ireland, they do get a lot of flack, but it's just because this was a poorly set up union. It wasn't set up to be the EU, to have the Eurozone, to have the euro as a monetary currency. It was mostly set up for free trade. So when you have free trade and one currency throughout the entire Eurozone bloc, the 18 nation bloc, you're going to have problems. You're going to have structural problems that were going to come out eventually. And now we're just seeing the magnitude of the problem with the EU.
Now, I'm going to put my political brain on for a minute, and I want to ask you a few questions, Solon, and maybe you can help educate me and some of our audience out there. You know, institutions and organizations, they would rather survive than just disintegrate. And so I think that the members of the EU, sometimes you get political posturing, sometimes you get a media fight about one side or the other. What would Germany want out of this situation? Are they just trying to wrestle some new policies out? What do they want?
Well, Germany wants, and to tell you the truth, and it's my honest belief, Germany wants to bail out Greece in the best possible political light, because for the past few months, we've been seeing not only radical extremist parties come out in Greece, which came into government, which actually created a coalition, but you're also seeing the same thing coming out in Spain with Podemos. But then you also have a third party in Germany that's starting to pick up steam. They're getting traction. They're getting votes out there. Alternative for Deutschland, AID or AFD. They're the third party in Germany that's actually threatening the status quo there. And when you see Angela Merkel is keeping quiet, and she has Schäuble doing most of the talking, doing most of the negative talking about Greece, and then her vice chancellor is kind of the optimist, and she's staying quiet. I mean, it's kind of political posturing. You have the good cop, bad cop, and as chancellor, she's the neutral cop. Mm-hmm. And you're starting to see that with a lot of European governments. When the extension was granted a few weeks back, you saw the first person to jump out and speak about it was the Prime Minister of Ireland, because he's being held accountable by his constituency. He said, hey, we didn't concede anything to Greece. There were no concessions made to Greece. They're going to have a hard time selling it to their public, but we stood the line. We're following through with Irish austerity, and they're going to have to follow through with their austerity plan. Portugal came out, said the same thing, and you had Spain a little bit later come out and say, hey, Greece didn't get anything. They're still messed up, and they were the first to actually say it out loud, but they said a few weeks back that Greece is going to need the third bailout, not 30 billion euro, which the Greeks are optimistically expecting, but Spain kind of broke it in a way that Greece is going to need an additional 50 billion euro. So you see these head of states trying to essentially sell the Greek debt problem, the negotiations, in a way that they're keeping their seats safe in government.
Hey, I got an interesting question for you. What is your take on and I forget his name, the Prime Minister of Greece? What's his name again?
Tsipras. Alexis Tsipras.
Yeah, Alexis Tsipras. What do you think? After Angela Merkel came out and fired her warning shots last week, the Greek response to it was quite interesting to me. They fired back with basically Greece demands on Nazi war reparations and German asset seizures in terms of the negotiating tactics. What do you think of that negotiating tactic where they started demanding more Nazi war reparations in response to Germany's adherence of repaying every cent of the debt?
Yeah, that's actually not that's not a new thing with Greek.
Mhm.
The Nazi war reparations has actually been a thing for decades, and it's something that came into light again from 2010, 2012. It took the limelight, and going into the new Eurozone, the new bailout that came out after 2012, Nazi war reparations became a huge storyline and a huge plot line. It's just that the previous coalition, the New Democracy Coalition that was in power up until January, they were towing the European line, so to speak, and they were doing everything they could to negotiate with the EU. They weren't bringing up the war reparations. It comes out to an estimated 90 billion euro. So they never actually brought that up to the Eurozone. But it was a storyline that a lot of people within Greece were talking about, how, if anything, Germany should foot some of the bill and pay back 50, 100 billion euro just to make the debt load a lot easier. And it's something that the Greek officials, Tsipras, Varoufakis, have brought up just now, just because they're kind of losing a little ground, I feel, within Greece. I mean, we don't know what's going on behind closed doors, but you're starting to see there is a little bit of dissent coming out from the Syriza party, because they're not really a united party at the moment. There's some who are a lot more radical than others, and with Tsipras and Varoufakis, you're getting the moderates, but there are a lot of people within that party, a lot of parliamentarians who are much more extreme, and they want some of these issues to be brought forth in front of the European Union.
You know, I found it was a very interesting back and forth the last couple of weeks between Merkel and the Greek parliament and leadership and whatnot, just going back and forth regarding the debt burdens of, the repayment plans. And, it's seemingly like almost every day we see another headline regarding they said this or they said that. Just today you saw some more headlines coming out where, the who was it? It was coming out of the EU group, out of the Eurogroup meetings. Greece may need a Cyprus-style capital control. Angela Merkel, Germany must pay Greece more reparations. Another headline: Bank of England director, Greece will not, in any realistic scenario, repay its debts. Varoufakis denies sticking the finger to Berlin. A Greek exit would be the beginning of the end for Europe, warns the EU chief. Greco-German relationship reached breaking point as ECB's warned to stop asphyxiating Athens. How Europe is playing a survival of Greece, of the Greek exit and whatnot. It just like everybody has an opinion. It's just this back and forth. And you know what? I don't think anybody knows exactly what's going to happen in the Greece situation. And I am certainly not an expert on Greece politics or monetary policy or debt repayment systems from a national perspective. But this thing, I do not see this having a quick and clean conclusion. I think it's going to, there certainly could be a conclusion where it's negotiated, and this could just be the beginnings of the everybody firing their bullets, so to speak. But at the same time, I think it's going to take a while to come to some conclusion. There's going to be some volatility in the Eurozone because of it.
Yeah. I mean, in my opinion, like all political negotiations, most of the progress is going to happen a week before the deadline.
No doubt.
It just feels that way. Whether it's Greece, whether it's the U.S. and Congress, once there's a deadline set, and the deadline is another 3 months away, we're not going to see much progress until the 3 weeks leading into that deadline, and it's just a story of politics.
You know, it's the same way it is everywhere. Every time we've had a debt ceiling discussion here in the U.S., We've known about it for years in advance, and it's always came to the final conclusion: are we or are we not going to shut down the U.S. government? And it's almost like the 25th hour negotiated pact that ends everything. So that's par for the course with politics everywhere. So, anyways, Solon, thank you so much for joining us today to talk about the Greece situation. Much appreciated. I just want to tell you publicly that how impressed I've been with your diving into not only understanding all of this, but just the trading perspective. You've only been a part of us over there at Tackle Trading for a few months now, and each and every one of you. And we actually, Solon, we talked about you on our coaches meeting yesterday, talking about planning the future of Tackle, and we've been just very, very impressed with the journey that you've undertaken over the last few months.
Wow. Thanks a lot. I mean, I appreciate the praise. And I do want to announce that this has been my first month where my credit spread system has been profitable.
Awesome.
It looks like I'm going to be taking in 20% on the month. Expiration Friday is still not here yet. So, but it's credit to you guys. And you guys are making the videos. You guys are doing the coaching shows. I mean, all I do is sit back, watch, and, spam the chat room.
Well, I know you say that. I got to jump in on that, Matt. So there are other people that have access to those and don't take advantage of them. So it's a two-way street when it comes to education and student-teacher relationships, because it's not only that we have to put out the content and educate and give the right information, but then you also have to take it and apply it. So congratulations on your month. That's awesome.
Absolutely. He's only been trading for. What? How long have you been live trading for with us? About 3 months? 2 months?
Yeah. Live trading. I placed live trades from I believe mid-October.
Yeah.
But to actually launch my credit spread system, it's mid-January. So
we're talking 2 months into this, and he's already shown a 20% return in a month, Tim. Think about that for a second. That is awesome. That is awesome. And I love hearing that. I love hearing that positive news. And honestly, Solon, that's going to give somebody else the dedication, the desire, and the mindset that they can do it. And you can be an inspiration to them as well. So thank you very much for sharing that with us and coming on here and talking about the Greek situation. I want to quickly get into a subject regarding the Fed. Tomorrow, the Fed is going to be announcing monetary policy. There are 8 major central banks in the system. And just to kind of list those central banks out, let's see if you guys can name them all. Solon, give me one of them. We'll play the central bank name game, okay? Solon, you name one, then Tim has to name one.
All right.
Okay. I'm going to go with the Australian Reserve Bank. Is that it? ARB, the Reserve Bank of RBA.
Yeah, the Reserve Bank of Australia, RBA. Good. That's one. Tim?
Bank of Japan.
Bank of Japan is 2. Solon?
All right. I'm going with Bank of England.
Bank of England, the BOE. Okay. Oh, and you also have to name their interest rate from now on.
Mm-hmm. Well, did we say the European Central Bank yet?
No, we have not. ECB.
And the lending rate's 0.25?
Nope. Tim, mistake number 1, 0.05 is the lending rate. Got to have that 0 there. Okay, Solon.
I'm going with the Fed.
Okay, you got the Fed, the FOMC. What's their rate?
I want to go with 0.25.
It is 0.25. Good. Tim. Just to recap, we got the FOMC, the ECB, the Bank of Japan, the Bank of England, and the Reserve Bank of Australia so far. So we're
the Swiss National Bank. I'm going to stick with the major currencies for right now. The Swiss National Bank.
Swiss National Bank. What's their interest rate?
Man, I swear it's negative.
It is, but it's negative what?
0.75.
Good job, 0.75. That's a negative. The only one that is actually announced as the majors as a reserve is the Swiss. And it's at 0.75 as a negative. However, because of their quantitative easing programs, both the Central Bank of the European Central Bank and the Bank of Japan have negative lending rates as well. We're missing two of them. Solon, you're next.
Wow, I didn't know there were a lot more central banks than that.
I'm
going to go with Canada, the Bank of Canada.
Bank of Canada and their lending rate?
0.75.
0.75. And Tim, the last one?
Well, we've hit all the major currencies. What about New Zealand?
It is the Reserve Bank of New Zealand, and their lend rate, which I'll give you a hint, it is the highest of all of them.
But it's not the highest globally, even for some of these major economies, right?
No, it's the highest of these 8 majors.
2%.
Nope, 3.5. 3.5%,
oh, wow.
which leads me to the reason I bring it up is the carry trade. Obviously the dollar is very, very strong right now, but the New Zealand currency, the New Zealand dollar, is a commodity-based currency, right? Mm-hmm. It's a commodity-based currency and that doesn't mean it's tied to, it means their economic value is based on commodities, mining, drilling, all that jazz. It has an interest rate of 3.5%. So once the U.S. dollar starts to come back down, which I do not anticipate for at least a while here, but that could be a great carry trade. A nice little stable mining currency like the Bank of New Zealand, like New Zealand dollar, still get a carrying like at least 3.25% positive interest rate. That could be an absolutely wonderful carry trade down the road.
Mm-hmm. Yeah. Yeah, and the carry trade is such an interesting concept for a long-term investor. Everybody should look into it. Building a positive swap rate from the currencies. It's not even that hard of a trade to really wrap your head around once you've dug into it a little bit, Matt. And I think everybody
really
needs to become
trade.
Yeah,
it's an extremely simple trade. Most things are difficult because we've never done them, not because by concept they're hard. It literally is a click of a button, right? That's all it is. And if you sell the dollar, the U.S. dollar, and buy the New Zealand dollar, the U.S. dollar has an interest rate of 0.25. The New Zealand dollar has an interest rate of 3.5. You get to carry the positive interest in the two of them. So you sell a currency with a lesser interest rate, you buy a currency with a higher interest rate, you get to carry the positive interest rate. And it's 3.5% yearly, but it's on the contract value, which is 50-to-1 leverage tradable instrument, which can be a very, very, very good return when you're dealing with 50-to-1 leverage on that interest rate. So it would be like 120% ROI yearly. Just on the carrying of the interest rate. So, it's a wonderful trade. And for those of you who are new to trading, new to currencies, new to carries, I do have some videos over there at Tackle Trading. Just type in the search carry trade, and you can look at that. And I think eventually I'll put the carry trade, some of the carry trade aspects of it in the Forex report, but not until the dollar starts weakening.
Cool.
You could do it against the yen and the New Zealand dollar. That'd be interesting. Sell the yen by the.
What about against the euro?
You could do it against the euro too. It would especially either the two I like doing the carry on right now are the euro and the yen. Both of them, I don't dare trust the Swiss more than a couple days. But you got the yen and the euro, which are both, negative interest rates in terms of their quantitative easing programs. You could do it against the euro. Nothing wrong with that.
Mm-hmm. Mm-hmm.
Okay, here's I'm going to give a quick update of the Fed. We're going to close up shop for the day. The FOMC is going to be announcing monetary policy tomorrow, Tim and Solon. The expectation is that, everything is around patience. Guns N' Roses, patience. That is all anybody cares about. In December of this previous year, they replaced the considerable time language in the FOMC policy statement, meaning they were going to maintain a historically low interest rate for a considerable time. They replaced that with the word patience. I talked about that in the Forex report, both the video portion and the written portion of the report this past week. I'm just going to throw it out to you guys. Do they remove the word language patience from the FOMC policy statement? Tim first.
I don't think so. And I think equities have a muted response. And I think currency is going to have a volatile response. And your guess is as good as mine, quite frankly. Because you never know with these volatility events. Banks or institutions might already be coming in with an intent in mind. and they just use the event to create volatility.
It's an AM earnings report. You just don't know what the institutions are going to do. And quite frankly, you don't know what the high-frequency systems are going to do either, given the movement out there. But Solon, what do you think?
Still a little too soon. It depends on when and I do think they know already when they expect to raise interest rates. So we could possibly see it 3 months before then. So if they're going to raise interest rates in the summer, I feel like we may be a month or two out before they remove the language.
Gotcha. My personal opinion is I hope they do. I hope they do as a capitalist. I hope they do. But it doesn't seem like this is the time the Fed shocks us. It doesn't seem like with the market coming down 5% over the last couple of weeks, and quite frankly, with the negative economic news we've had just the last couple of days, I'd be a little surprised if they remove the language right now. I agree with both you two. I think it's a little bit out, and I think they'll take the language out maybe 1 or 2 cycles before they actually raise the interest rates. And so, if you're looking at June, I mean, you're probably going to be removing the language more than likely in the late April. So I think I said in the Forex report there's about a 20% chance they take the language out this time. That does increase in my estimation to about 50 to 60% in the next meeting. So I think it's going to be the next meeting. But if they do take out the language, guys, expect to see the dollar rally. If they do not take the language out, which is as expected, I expect volatility up and down, and I agree with Tim, a muted response. Guys, you have been listening to the Trading Justice podcast presented by Tackle Trading. My name is Matt Justice with my co-host Tim Justice and our amazing, wonderful student Solon coming on here and talking about the Greek situation. Hopefully you enjoyed the podcast. If you did, go out there to iTunes and leave us a nice little 5-star review, and go out there and check out Tackle Trading. Get in the game and start trading and taking control of your financial future, one trade at a time. Any parting shots, Tim?
Well, I'm really happy that you didn't use special guest.
I did on purpose, by the way.
I was about to say that.
Why do you think I said amazing, awesome? I about said beautiful. Beautiful almost dropped off my tongue on that one, but that was done on purpose. We did not get into the making of the Fed movie. Maybe we'll get into that in our podcast next Monday, Tim. We still got to do the making of the Fed movie. That dream is still really, really just in my.
We just got to make the movie. Yeah, we have to make the movie. We have to enlist some film school kids that are working on a college project or something. Have some fun with it. You might have to dress up, Matt.
I got Daniel Day-Lewis playing Mario Draghi. I don't have some college student.
I don't think we can pull it.
I have Daniel Day-Lewis. He's only done 4 movies in the last 20 years. Okay, this is made for him. Made for him. I got Edward Norton playing Husnar. Okay, I got Betty White playing Janet Yellen. Come on, this has to be. My dream was not a college production. I'm not going to go to the local high school and say, let's put a play on.
Well, you're going to need a script. We're going to have to pitch it, Matt. We might have to be out in Hollywood soon.
This is $100 million idea. $100 million. That's what it is. I'm not kidding. I dream about it. All right. You've been listening to Trading Justice Podcast. We're out.
You've been listening to the Trading Justice Podcast. If you've enjoyed yourself and think that the conversations and topics we've covered are important, help spread the word. Give us your feedback. 5 stars on iTunes, like us on Facebook, and follow us on Twitter. The Trading Justice Podcast is proudly sponsored by TackleTrading.com. Get off the sidelines and get in the game.